The big banks are in danger. I'm your host, Steve Van Metre, and thanks for joining me today. The Fed is holding an emergency meeting on Monday to stem off what could be a massive insolvency crisis that is about to hit the banks. Let's over to the Fed where we picked today's story up. On Thursday, they announced an expedited meeting to be held on Monday where they're going to discuss the advance in discount rates charged by the Federal Reserve banks. Now, you may remember back to the great financial crisis when all of a sudden there was a massive wave of insolvencies. The Fed opened the discount window and brought the banks in and effectively gave them massive unlimited swap lines. Could this be that the Fed is already trying to get ahead of what is a major crisis? Well, let's continue on. Because the discount rate is the interest rate charged to commercial banks and other depository institutions on loans they receive from the regional Federal Reserve Bank's lending facilities, also known as the discount window. The Federal Reserve banks offer three types of credits to depository institutions: primary credit, secondary credit, and seasonal credit, each with its own interest rate, and all discount window loans are fully secured and backed by the Fed. Now, recently, earlier this year, the Fed did make some changes. On March 15th, the board announced the following changes to the discount window. They narrowed the spread of primary credit rate relative to the general level of overnight interest rates to help encourage more active use of the window by depository institution to meet unexpected funding needs. And they also announced that depository institutions may borrow from the discount window for periods as long as 90 days, prepayable and renewable by the borrower on a daily basis. So what's going on here is something perhaps even going back to March, where the Fed noticed there were perhaps insolvency issues starting to brew, where they were telling the banks, look, not only can you come to the window and get money, but don't worry, you effectively don't have to pay it back. We'll give it to you for 90 days, and guess what? You can just renew it over and over and over. So what's going on here? Is there perhaps some stress in the banking system that the Fed is trying to get ahead of? Well, quite possibly there is. But let's take a look at the advance rate to see if perhaps the issue is there. And with the advance rate, that is the percentage of the value of collateral that a lender is willing to extend as a loan. The advance rate helps a borrower determine what kind of collateral to bring to the table to secure the desired loan amount and to help minimize a lender's loss exposure when accepting collateral that can fluctuate in value. So perhaps what we're seeing here is the Fed may actually increase the advance rate, letting banks lend against a larger portion of an asset and secretly giving them access to dirt cheap Fed money, perhaps that they're going to lower the interest rate on behind closed doors on Monday. Is that possible? Could we see that there is actually stress in the banking system? Well, the answer is there is. Let's take a look. Here's a chart of the net percentage of domestic banks tightening standards for commercial industrial loans at both middle market firms and small firms, and that is in blue. And the way you read this chart is really simple. Where you see the black line going across, every part where the blue line is above indicates tightening. So when you see the blue line cross above the black line, the banks are increasingly tightening lending standards. Now on the way down, they're still tightening, but just not at the same pace. Fewer and fewer banks are tightening standards. Below the black line, you see that they're easing. Now, I've overlaid the discount window primary credit rate in red, and here's what you can note. When you start to see the Fed raise the primary credit rate, what happens is banks starting to tighten, then all of a sudden you'll see the Fed start to pause here, perhaps capitulate, and then lower the discount rate to fend off a recession. They're often too late. You'll note they did this back in 2016 and gave up just as the banks started to tighten lending standards. What are we seeing today? Lending standards are getting tight. The Fed's been raising rates, so perhaps this is a backdoor way that they're going to start cutting rates. But let's continue on, because there may be some other issues in the economy that the Fed is focused on. We saw on Friday the Chicago PMI, or Purchasing Managers Index survey, plunged. Now remember, this is a regional Fed data that they're kind of pulling out of, plunged unexpectedly back into contraction in September to 45.7 versus 51.8. Now the way you read these charts is at 50 is unchanged from the prior month. A contraction would be below 50. The smaller the number, the greater the contraction. Above 50, and the larger the number, the greater the expansion expansion. So when you see a swing from effectively 52 just to below 46, that's a pretty big move, and the lowest print for the survey since June of 2020. And you can see in this chart provided by Zero Hedge and Bloomberg that you'll note that these big drops are usually coincide with recessions, and here only to the last time we noted from the pandemic. So it's entirely possible here that the Fed is already seeing signs of stress in the economy, and they want to get ahead of the issue, because when we look deeper at the Chicago PMI data, well, it's not that pretty. Here you can note that prices paid rose at a slower pace, and that is actually a sign that inflation is about to roll over, something the Fed has really been talking about, trying to bring under control. But look at this. New orders fell at a faster pace, signaling contraction, what we've been talking about on the show quite a bit lately. And when new orders go down, what have we talked about happens? Well, that means employment. You don't need as many workers. And here we see employment fell in the direction reversed, signaling contraction and perhaps an increase in layoffs to come. And then you see that drops to production. If you have fewer orders, you don't need as many people to produce, and you don't need the same rate of production. That too fell and reversed, entering contraction. And of course, backlogs, when you get caught up with backlogs, that reversed, signaling contraction. So this could be an early warning by the Fed to say, hey, perhaps we've got this wrong, and we need to start getting the banks the capital and cash they need. Also, it could be having something to do with the housing market. The U.S. housing prices fall for the first time since 2012 as pandemic frenzy is hitting the skids as mortgage rates climb. The index of 20 cities posts its first monthly decline, get this, since 2012. A national measure of prices in 20 large cities fell 0.44%, not much, in July, the first drop since March of 2012. The last real estate crash that ended in 2012, ushering in 10 years of price gains, is capped off by 2-year pandemic buying frenzy. It's possible what we're seeing is the Fed being concerned that the housing market's about to turn and the banks are going to find themselves right back in the same situation they did in 2008, and they want to get ahead of it. But one thing that you shouldn't worry about if there is a housing crisis and prices crash, and that's your portfolio. I'll put a link up here to Portfolio Shield and description below. Because it may not be any of those things. It could be that the Fed is really concerned about all the stress that banks could undergo during the crisis, and they're just trying to get ahead of it, as we see in this recent presentation from one of the Fed speakers. Governor Michelle Bowman spoke recently on the large bank supervision and regulation, and here's what she had to say. Is one area where we need consistency is clear is in the board's stress testing framework. And stress testing has been used to assess banks' capital positions and determine whether they have sufficient capital to both absorb losses and continue lending during stress conditions. This process has evolved considerably since its inception, and that evolution is important to ensure that stress testing continues to be relevant and effective. Now, she spoke about this last week just ahead of this expedited meeting, and perhaps there's a reason the Fed thinks the banks are going to be under a lot of stress is because there's also a new stress test coming, and perhaps it's not really the stress test that they're saying it is. Perhaps they're really concerned the banks are in big danger and they want to, again, get ahead of the problem. Let's take a look. Wall Street giants face new extreme weather impact assessments. Weather? What does that have to do? But nevertheless, 6 large banks are being asked to participate. The pilot climate scenario analysis exercise, which will take place during 2023, marks one of the most concrete steps by bank watchdogs during the Biden administration to address risks that changing climate pose to the financial system. In a stark reminder of the damage the severe storms can cause, with more than 2.6 million Florida homes and businesses without power still as Hurricane Ian ripped through the state. And maybe this is just a clandestine way of the Fed to say, look, we know that there are climate risks out there, but are they really that damaging to the banks? Or perhaps they think that something else is really going on underneath here. That's why they're going to open up the discount window a little bit more, perhaps lower rates, extend the term of those loans. What do you think? Well, I'll let you weigh in the comments. Let's continue on. The Fed said that the program is meant to assess the resilience of firms under hypothetical situations. It won't have any capital or supervisory implications for the firms. Participating firms will analyze the impact of the scenarios on specific portfolios and business strategies, and then the board will review the firm analysis and engage with those firms to build capacity to manage climate-related financial risks. In a statement on Thursday, the Fed said this pilot was different from regulators' annual stress tests, which are meant to assess whether lenders can withstand a severe recession. The climate scenario analysis exercise, on the other hand, is exploratory in nature and doesn't have any capital consequences, or perhaps maybe it really does because they're pulling this one well ahead of the annual stress test. Maybe there's something really going on here. Even our politicians think that perhaps there's something suspect. But Pat Toomey, the highest-ranking Republican on the Senate Banking Committee, blasted the effort as a bid to ultimately produce new regulatory requirements. He said in a statement that banks were already prepared to deal with risks from global warming and that the pilot was really the first step toward pressuring banks into limiting loans and to investments in traditional energy companies and other disfavored carbon-emitting sectors. But perhaps that's not the real issue. Perhaps, as we've been talking about on the show the last couple of weeks, banks are starting to take losses and the Fed's getting concerned about it. So what would you do in the face of billions or hundreds of billions of losses? Open the discount window and extend credit to the banks so they can get through it? Let's take a look. Banks are dealt with fresh blow of collapse of Brightspeed debt sale as underwriters now shelving $3.9 billion offering for buyout by Apollo as investors are fleeing risky debt amid recession fears. This transaction, which was meant to help fund Apollo Global Management's purchase of the company, is the latest large acquisition financing to stumble. Banks face significant losses. Now there again, there's your reason to go to the Fed and get some money on tens of billions of dollars in buyout debt that they committed to months ago and are trying to offload just as rising interest rates, fears of a deep recession are causing investors to flee risky debt. Between Citrix and Brightspeed, banks are now expected to fund with their own cash over $11 billion of buyout debt that was originally meant to be syndicated to investors. More looms on the horizon as additional acquisitions approach closing, including its deal for the take private of Nielsen Holdings and Tenneco. So here again, perhaps the Fed is just saying, hey, we recognize that all these promised loans and these risky loans that the banks committed to, that they can't offload that capital, is going to take a hit to their balance sheet. So we'll extend them credit on an unlimited basis, perhaps at a discounted rate, so they can get through it. And that way, no one will know if something goes wrong, because we'll do it behind closed doors. But perhaps the shocking truth is none of those things may even be the issue. It could be, well, this. And here we can see the minutes of the Board of Governors discount rate meetings. You can see they have, well, a lot of these. And you might note, looking back over the last few years, that really and only during the pandemic did anything bad happen. So perhaps this is something that the Fed is quietly starting to get ahead of. Perhaps it's nothing. We'll soon find out. But in the meantime, are the banks going to get out of this unscathed, this next recession? Well, probably not. But if the Fed has any hand in it, we know they'll be doling out money through the discount window. I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.